This video will go through the complete basics of advanced market structure, and I guarantee you after this video, you will have a significant understanding on advanced market structure. So, we know advanced market structure is based off of your swing points. Depending on where the swing points form, either on the lower time frame or the higher time frame, that will determine the type it is. So if you remember your swing points, here's an example. Your swing points makes up 3 candles. The first candle and the third candle, its bottom wick is higher than the middle candle's bottom wick. And here, this creates your swing low. For a swing high, your middle candle has the highest upper wick in comparison to your first candle and your third candle. So that is your swing high. So going back to this graph, depending on where your swing points form, they will determine one of the 3 types of swing points. Like so. So they are the 3 types of swing points in your advanced market structure. Now let's go over your long-term points. So long-term points occur on the higher time frame, right? Imagine this was your higher time frame scenario. On the higher time frame, when price retraces into a PD array, in this instance, because we are bullish, it retraces into a discount array, the swing low that gets formed in this PD array becomes your long-term low. Because remember, this is your higher time frame. So this is a long-term low. Because if this low was to get broken through, like this, that becomes your market structure break. And it could initiate a reversal on the higher time frame. So your higher time frame bullish sentiment now comes down to your bearish sentiment. So based off the higher time frame reversing, now on the lower time frame, you will switch to look for shorts. Hence why this is a long-term low. This is also a long-term high, in the sense that this is your higher time frame draw on liquidity. So on the lower time frame, this is your overall draw on liquidity. You will look for confirmations on the lower time frame to target this overall draw on liquidity, because it is in line with your higher time frame bullish directions. Old highs should become violated and they should become your draws on liquidity. Hence why this is a long-term high. The easy way to think of it is external range liquidity and internal range liquidity. Every time a new range is created, your external range is low and your external range high on the higher time frame. Because remember, your long-term points only form on the higher time frame. They become your long-term lows and your long-term highs. Now, if we go to intermediate term highs and lows, they occur in 2 ways. The first way is, if we look at intermediate term highs, to its right and to its left is a short-term high. So the highest swing point in between the first swing point and the third swing point is your intermediate term high. So essentially, the first way an intermediate term point can form is when it has a short-term point on both sides beside it. So if I invert this just becomes your intermediate term low, because there's a short-term low to its left and there's a short-term low to its right. So that's the first way an intermediate term point could form. Now, the second way it could form is, if you imagine this on the lower time frame, let's draw a better example. Like so, here. So imagine this is where you have your market structure shift. You only have a market structure shift here because there was an intermediate term high here. So the second way it forms is, in this scenario, when price was currently bearish and it created a premium array in the form of this imbalance, when price retraces back to that premium array, it creates a swing high within this imbalance. And then it retraces lower and displaces higher. So after taking out this intermediate term high, that becomes your market structure shift. So that's the second way your intermediate term point could form. It is formed when a swing point is created within an imbalance or a fair value gap. So remember, for these 2 first points, long-term points and intermediate term points, you want to see stay intact if price was going to continue in your intended direction. Because if an intermediate term high gets taken out, that is likely going to be your market structure shift. If a long-term point gets taken out, that is likely going to be your higher time frame market structure break. So now that brings us on to the last point, which is the easiest one, short-term points, right? Short-term highs and short-term lows. They are just your basic swing highs and swing lows. So you could say long-term points and intermediate term points are your short-term points. But what differentiates your intermediate term points and your long-term points from your basic short-term point is the fact that long-term forms of your higher time frame PD array and intermediate term forms when there are short-term points besides it or off of an imbalance. Short-term points, when they become disrespected, that could either just be a sweep or your target for your draws on liquidity. So now let's look at how we can map out our advanced market structure. Here, It's clear that on a daily, being my higher time frame for this scenario, and let's use the hourly for my lower time frame. We had the sweep, price took out the swing high, and after that we could expect bullish price action, which is what we are currently getting here. Discount arrays being respected, premium arrays being disrespected. So here you get another sweep, and price displaces higher, taking out this high. That gives you another break. So now, where are your long-term points? This is your long-term low, because that low swept the previous low. So if this low was to get violated, that becomes your higher time frame market structure break, and you could anticipate for bearish price action after that break. Now, where are your long-term highs? This was a long-term high. But then, because we are bullish, this long-term high became your drawn liquidity in the form of buy-side liquidity. After that long-term high gets taken out, you can anticipate for a retracement before continuing higher, new range to be created, and the range simply just becomes this. The external range low becomes your long-term low, and the external range high becomes your long-term high. So essentially, that is all your long-term point is. In a bullish market, any respect of discount arrays become your long-term low, and any old highs become your long-term high. So let's play price out and see what it does. Notice how it retraces back into this imbalance. And then it has a strong displacement higher, giving you another break. So remember, this was your long-term high, and this was your long-term low. So now, because we had another range created, this becomes your long-term high, and this becomes your long-term low. Remember, you could use internal to external range liquidity now. When price took out this external range liquidity, comes into internal range, and then it takes out this external range liquidity. So now the new range that gets created, external range high, external range low, becomes your long-term points. Now, this is where you could drop down onto the lower time frame. So here on the daily, look at what it does. There was a large imbalance left behind. Price comes back into that large imbalance and then takes out your long-term high. So if you go down onto the hourly, this is what it would look like. When price came into this imbalance and swept the previous liquidity, this becomes your long-term low. Because remember, on the daily time frame, this was just a mitigation into the daily imbalance. And this becomes your new long-term high, because it took out the previous long-term high that we had marked up here. So if we focus on just this segment in price, let's mark out your intermediate term points and your short-term points. So here, this is the short-term point, right? Because that is sell-side liquidity. This was an intermediate term low. Why? Because look at where it formed. Look at what is to the left. Short-term low. Because that's just your basic sell-side liquidity. This is also a short-term low, because it is a swing low and it's just basic sell-side liquidity. So intermediate term low is here, short-term lows to both of its side, making this an intermediate term low. This is also a short-term high. It's not an intermediate term high because it didn't form of an imbalance and it doesn't have short-term points to its left or to its right. So this is just a short-term high. However, here, this is also an intermediate term high, because you have a short-term high here and a short-term high here, or you can use this short-term high. So because we have a short-term high here, and if you look closely, this wick is also a short-term high. What does it make this high? An intermediate term high. So when this intermediate term high gets broken through, that becomes your market structure shift. Or you could use this short-term high for your market structure break, because this short-term high, even though it wasn't an intermediate term high, it still broke this intermediate term low, creating an institutional swing point with this long-term low. So then, when price took out this short-term high, that is valid for your market structure break. Now, obviously, because it only took out this short-term high with a wick, that isn't very high probability as opposed to this heavy bullish displacement with a full body closure. You want to see that to determine whether your market structure break or market structure shift are high probability or not. And these up here are just your usual short-term highs. They are just your normal buy-side liquidity. Here. Here. And here. If you look at it from a trendline standpoint, they were just your low resistance liquidity that got swept by this high, and then it implemented an intermediate term high. So, because we are currently in a higher time frame bullish direction, you want to see long-term lows stay protected and long-term highs become disrespected. And when you drop down onto the lower time frame, the retracement into a higher time frame discount arrays, you want to see intermediate term lows get disrespected and intermediate term highs stay respected. The same for short-term lows and short-term highs. Short-term highs should only be used as sweeps to continue lower, and short-term lows should be disrespected fully. Now, when you have that reversal, i.e. price breaks out a short-term high, giving you a market structure break, or it breaks an intermediate term high, giving you a market structure shift, this is when you could anticipate for short-term highs to become disrespected fully, short-term lows to either just be used as sweeps to accumulate longs and distribute price higher, and long-term highs should be your overall targets. So let's keep playing price out and see what it does. Notice how it takes out this long-term low. But the thing is, it doesn't have a full body closure past this long-term low. So that makes it a low probability break. And I wouldn't determine that as my market structure break. Because remember, with this short-term high, it's the same principle. Whenever you want to see a reversal, you want to see full body closures with displacement past that high, past the swing low or the swing high to validate that reversal. So if we keep playing price out here, this just becomes your new long-term low. Look at all these lows. They are simply just your short-term highs, right? Because they are your basic trendline liquidity, as well as here. This low is just your short-term low. So remember, short-term high and short-term highs. We break through those short-term highs. And what does this give you? Another market structure break. Now, ideally, we should see this long-term high get violated because it's in line with our high time frame bullish direction. So here, look at what gets created here. There's an extremely small imbalance here. The price came back to rebalance. What does it make this low? Your intermediate term low. So there's an intermediate term low. Keep playing price up. You can see that intermediate term low stayed protected. And when price came back to this already rebalanced imbalance, this low right here was simply your short-term low. And then look at what price does. It displaces higher, taking out this long-term high. And that is how you can start to map out your advanced market structure. Remember, price is fractal, so whatever you do on the daily time frame, all the way down to your hourly time frame, it will be the same when you do it on the hourly all the way down to the 5-minute. Advanced market structure isn't an objective concept, it's highly subjective, depending on your trading style and your trading timeframes. Because here, you know that it takes out this buy-side liquidity. Imagine your hourly time frame. If we look at another example now, your hourly time frame being your higher time frame and your 5-minute being your lower time frame. So look at what you have here. So if I replayed to this is the long-term low and this is a long-term high. On the hourly time frame being your higher time frame direction. You know that price retraces back into this old imbalance before continuing higher. So in this specific scenario, because your overall drawn liquidity is this buy-side liquidity, when price retraces into this imbalance, you could jump down onto the lower time frame to look for confirmations because you are anticipating that the rebalance of this imbalance to create a long-term low. So let's drop down onto the lower time frame. So here, when price comes into that imbalance, you are anticipating a long-term low to form here. Because on the high time frame, this was a high time frame PD array and this was just a retracement. And already you could start out your short-term points and your intermediate term points. So here, where this long-term high is, that becomes your immediate draw. And look what you have here. You have a short-term high here. And a short-term low here. Price took out this short-term low. And because you are anticipating a respect on this discount array to follow the hourly bullish direction, you would anticipate for this long-term low to form. Now, the important thing here is this long-term low doesn't form until we actually get a bullish confirmation. But since we are anticipating a long-term low to form here with the respect of this imbalance, we could annotate this being your long-term low. This gives you a change in step delivery. It disrespects this fair value gap. And then this fair value gap becomes your inverted fair value gap. And you could use this to anticipate a respect of this inverted fair value gap before continuing higher and taking out this short-term high. This short-term high is still a short-term high. It's not an intermediate term high because a short-term high hasn't formed to its right yet. We have only had a short-term high to its left. So this is still your short-term high. And as you would expect, the short-term highs gets violated, giving you a market structure break. When you have this market structure break, this confirms your long-term low. This is your short-term low. And as you would expect, this long-term high gets violated in the form of a buy-side liquidity. So if you jump back onto the hourly time frame, this is your overall drawn liquidity. This means you could look for entries off of this. Price comes back. We have this imbalance here that I could possibly come back into. One thing to note is this short-term low and this short-term low could also be your intermediate-term low. But because this video is just going over the basics, let's not overcomplicate ourselves and just focus on the obvious definitions. Intermediate-term points are also a form of your short-term points anyway. So here, we could have an entry off of this imbalance. Stop loss below this long-term low, because you're not anticipating for this long-term low to get disrespected, right? Unless, on the hourly, it was to reverse completely. If that was the case, then your long idea would be invalidated completely anyway, because it is not in line with your bullish hourly sentiment. Stop loss below this long-term low, and you could have a take profit at this overall drawn liquidity. So display price out and see what it does. As you can see here, it took some time, but eventually took out your drawn liquidity. And look at how this low that got implemented respected this long-term low. So that concludes this video on the basics of advanced market structure. I hope you guys found this video helpful. If you did, please like and subscribe. If you have any questions or suggestions for future videos, please leave them below in the comments. Like always, take care and I'll see you guys in the next one.